Welcome to the Denka South Africa update. The objective of this call is not for us to sell anything to you. This is really an information session, and I've asked 4 members of the team, Doe, Madelette, Rico, and Koki, to give us a short 10-minute update on COVID-19, on the junk status implications, on how life looks through and after crisis, and a short snapshot on global financials and valuations right now. Without any further ado, I'll pass over to you, Doe, and your 10 minutes kicks off now. Okay.
Thank you, Nigel. Good morning, everybody. Nigel has asked me to give you a brief overview on the COVID-19 pandemic, and with particular reference to the implications for South Africa and the state of the epidemic in South Africa. So I should start off by warning you that I'm not a doctor. I don't hold myself out to be an expert, but I must say that the dire implications of this epidemic really hit home to me when sort of at the end of February, I read the report that was put out by the Imperial College in London. And I think most of you might have seen that report by now, but it really just underlined to me that we were really the world was really facing a very serious problem. And what it also underlined to me is that there was lots of speculation and lots of commentary and opinions being bandied about in financial markets by stockbrokers and other commentators. And what really struck me was that the real experts are the scientists, and they tend to base their opinions very much on fact. They tend to factually test all assertions. And I just thought, and I said to my colleagues at the time, that I thought that we would be better served if we concentrated on the information that was coming from the scientific community rather than the opinions and comments that were coming from the financial community, because a lot of that was based on incomplete information, hearsay, and could be quite misleading. So what I did is I made contact with Professor David Coetzee at the UCT School of Public Health, and I've stayed in constant communication with him for the last month. So I speak to him every couple of days just to update me on what is going on, and also to sometimes explain to me what the information that is presented to us means. So a lot of you would have seen various presentations, especially in the last few days, that have been published, that were done by the Department of Health, comments that are made by the Minister of Health. And it's just very useful to be able to speak to David and say to him, what does this mean? What does that mean? Because a lot of it is not always that apparent. So in the limited amount of time that's available to me, I wanted to just very quickly cover three issues. Why is there a need for a lockdown in South Africa? Why does it appear as though in South Africa we've had a lower infection rate than the rest of the world? And certainly it looks, based on the numbers, that the infection in South Africa has not been as serious as maybe we were led to believe. And then finally, just to touch on 1 or 2 economic implications. Madelette's going to spend a lot more time talking about the effect on the South African economy. So why the need for the lockdown? Well, because this is a very contagious virus. It has an infection rate between 2 to 3 times. That means that one infected person on average infects 2 to 3 other people. That doesn't sound dramatic, but in terms of epidemics, that means that the infection spreads very, very quickly. And if you think about it, from a single infection sometime in early December, this virus has now spread to every single country on the planet, and there are roughly about 2 million people, confirmed people that are infected, and there have already been 120,000 deaths. What makes it equally difficult is that the majority of infected people are asymptomatic, which means that they don't show that they're infected. And therefore the confirmed cases is really just the tip of the iceberg. So for epidemiologists, it's very difficult to know what the size and scope of this iceberg really is, because they're constantly having to extrapolate from a limited amount of data that has come from the testing that's been done. Because the only way to really determine what the full extent of the epidemic is through widespread testing. And certain countries, like particularly South Africa, is quite challenged in that regard. So in South Africa, we've to date completed about 80,000 tests, which means that we've tested roughly one person out of every 750 potential infected people. Countries like South Korea have a far higher testing rate. They've tested roughly one person out of every 150 people in Korea. And therefore, they've got a much better picture of what their problem looks like and how to deal with it. The virus has a mortality rate of estimated to be roughly between 0.8% and 1.5%. Now, this number varies widely from country to country, and you would have seen bigger numbers reported in certain countries. The calculation is very dependent on the accuracy and the relevance of the data on which it's based. And demographic and other local factors are also very important. So in some countries, like in Italy and Spain, where they have a large number of very old people, the mortality rate would look higher. In countries where populations are younger, the mortality rate would look lower. People that are most at risk are the elderly and people that have pre-existing conditions. So people that might have heart conditions, cancer, heavy smokers, people that are obese, they are more at risk. What made the authorities particularly nervous about the situation in South Africa is that, as we know, South Africa has about 8 million people living with an HIV infection and about 330,000 people living with a TB infection. And that makes them extremely vulnerable to this infection. And for that reason, our authorities were very, very, very careful about it. And that was one of the prime reasons why our lockdown occurred so early on in the spread of our epidemic and was so strict. And that has had positive effects, I think. The key challenge is to cope with the surge of patients. So as this infection grows, you'd have seen the example in many countries, it tends to peak out after a couple of weeks. But there's a period when there's a real surge in the number of infections and in the number of people seeking hospitalization. So the problem for South Africa is based on the projections of how our infection could grow. They estimate that we would have a peak requirement of about 15,000 ICU beds. And currently in South Africa, there are less than 5,000 such beds available. So that just gives you an indication of the scope of the challenge that we might face. In South Africa, currently we have about 3,200 ventilators, which is also completely inadequate. So a big motivation for the lockdown was just to avoid our health services being completely overrun by the number of patients seeking medical attention. Currently, they're hoping to manufacture maybe another 10,000 ventilators by the end of June, but that's a hope, and I suspect that that's a target that won't be hit. So the bottom line is that the lockdown is intended to slow down the spread of infections in South Africa in order to buy time for the authorities to be able to better deal with the large number of infections that are expected. And our infection our epidemic is expected to peak somewhere in July, August, after our initial restrictions are relaxed. So we are definitely nowhere near out of the woods yet. And the only enduring solution will really be if they find a cure or a vaccine, and that appears to be at least 12 to 18 months away. And then, once they've found that, there's going to be a whole process of having to manufacture for billions of people around the world. So there are going to be delays. So, this problem is going to be with us for a while to come still. So why does it appear that South Africa has a lower than expected infection rate? Well, nobody really knows, but there have been a couple of reasons put forward. The first is that we had a very early and very strict imposition of a lockdown, which has definitely had a positive effect. This prevented the spread of the infection from the initial high-risk groups into the general population. So the high-risk groups the initial high-risk group in South Africa were international travelers, people that brought the infection back to South Africa from having traveled overseas. That tended to be in the more affluent parts of society. And by instituting a strict lockdown, they were able to prevent the infection spreading very easily from that group into the general population. South Africa is also fortunate in that we have very good HIV and TB follow-up teams, which have been able to help them in isolating contacts with known infected cases. So in South Africa, because we have this high population or large number of people living with HIV and TB, particularly TB, we have teams of people that follow up to make sure that those people take their medication as prescribed. And a lot of you will know that with TB, there's a particular problem with drug-resistant TB. And so, that sort of is a unique strength that South Africa had, and they're using those teams quite extensively to follow up on every known positive case of COVID. It's also possible that the lack of widespread testing is just providing an incomplete picture, and that if we were able to test more widely, we would find that the problem is actually already a lot larger than we can see. And there's a big push happening this week to expand the number of tests done quite radically in order to get a better picture, so that the decision can be made as to whether this lockdown should be extended further, or if they start to relax the restrictions, how to do that, and to what extent they can relax those. Some of you might have seen rumors going around that South Africa has managed to escape a major problem because all of us have this BCG inoculation when we're children, and that's given us some kind of resistance to infection. I discussed it with Professor Coetzee. He says that there's no real scientific evidence to support that theory. It's simply a correlation that has been noticed, and that there is currently some investigation going into that to see whether there is actually any merit to that idea. It would be wonderful if it were true, but he's skeptical that that in fact is true. So I wouldn't hang my hat on that. And then finally, despite the lower than expected numbers, the trends in South Africa are largely consistent with global examples. And it's expected that our community infection rate will accelerate once the lockdown restrictions are relaxed. So we're certainly not out of the woods. There's no room for complacency. And he keeps reiterating that we are not special in South Africa. Our epidemic will run the natural course, and therefore they will continue to prepare for that expected peak sometime in early August, perhaps. Finally, if I can just touch on one or two economic implications. As you will all be painfully aware, the economy's come largely to a standstill for the last 5 weeks, and this is going to have dire consequences for the South African economy. The results of this will become more apparent in the next sort of 12 to 18 months, I suppose. And I think Madeleine will touch on that a little bit more. The current lockdown might be extended, depending on the trends that are observed this week. And the main thing is to get that infection rate between below 1. So what that means is that an infected person should infect less than one other person in order for the epidemic to sort of implode on itself. And that's the number that will be watched very, very closely. As long as that number stays above 1, there's a real risk that we can still enter into an exponential growth phase, and that the epidemic would just swamp the health authorities in South Africa. So it's very likely that there will be further lockdowns or further restrictions on movement during the next 12 to 18 months. So this is something I think we should all get used to living with for at least probably the next 18 months. Another implication for South Africa is that we're not alone in this. The whole world is experiencing the same thing, and that means that all of the aid agencies, the traditional agencies that would provide financial and other assistance to developing countries, are going to be stretched very, very thin. There's going to be huge demand for their resources, and we're probably just going to have to stand in the queue with everybody else. So that means that we're going to have to largely rely on ourselves to pull ourselves out of this. Sectors that are obvious ones that are going to be very affected are things like international travel and tourism. I think it's going to be a very, very long time before any country is going to allow a plane load of passengers to just disembark uncontrolled on their soil. It's going to be a while before we're allowed to do that again. I think large gatherings like conferences, concerts, sports events, those are going to be restricted or controlled for quite a while to come. And then there are some other long-term changes to the way business is being done. So we're all working from home. I think some of us are finding that it actually works pretty well. So in future, it might be something that becomes more common. Conference calls are becoming the rule of the day, as we experiencing now. We're sitting here talking to 84 of you. A number of overseas conferences that we were going to attend in the rest of this year have now been turned into virtual conferences. So instead of traveling to New York, we'll be sitting at our office in Cape Town, listening to presentations on our computers. And then home delivery. I think the one industry that's managed to keep working through most of these lockdowns are those guys delivering parcels to your house or food to your house. And so I think those habits that we're learning now are most likely going to endure. So I think industries like that have had a nice shot in the arm. I'm going to stop there. If there are any questions, please pass those on to Nigel, and I'll try and touch on those. If there are any other questions you want to contact me after the call, please do that. There's so much information available on this topic that it's impossible to cover it in such a short time. Over to you, Nigel.
Great, thanks, Doug. Thanks for giving us a short update in the time allowed. Madeleine promises me she's going to get through junk status implications in 5 minutes. So Madeleine, if you're able to get us back on time, that would be fantastic. So over to you.
Okay, so well, I have an easy job to do. Very briefly, just as an opening comment, is that it is not the things that you see coming that blows you out of the water. So I think junk status was widely anticipated. It was the last rating agency to reduce us to junk. And as I said to Nigel in the weeks leading up to it, the only reason I wasn't sure that they would downgrade us to junk is because they hadn't done it up until then. And indicators were so clearly junk indicators that it made no sense whatsoever that they hadn't downgraded us yet. So the impact of a downgrade to junk is, in my opinion, nothing. It was widely anticipated. Everything was known. I mean, if you're paying any attention to the South African economy and policymakers and macro indicators, really there were no surprises that we would be downgraded to junk. Why were we downgraded to junk? Because our political system is incapable of making trade-offs. Growth enhancing trade-offs. We have very, very capable entities in our political system that manage to skew the odds in their favor and extract enormous benefits from the political system. These are things that need to change. So all the structural reforms that need to happen are well known. What good policy looks like is well understood. The question is, how do you get from where we are and the policies we've embraced to date to where we need to be, the policies we need to embrace to change the trajectory of this economy? And the answer is we need to go through the special interests. We need to take on the unions. Simply saying inflation-linked increases from now on might have been fine before we took the knock from Corona. And just to explain the knock on Corona, every week that this economy is locked down, you can more or less write 2%, 1.5% of GDP off completely. And I say 1.5% because roughly 20 to 25% of the economy is working. These are the essential services. So every week it's 1.5% off the economy, off output. We just don't have the reserves to do what we're doing, frankly. I know that we have serious considerations and concerns about the state of our healthcare system and the people who are reliant and dependent on government health systems. But the economy just can't. We were not in a position, we didn't have any prudent build-up of reserves or extra. So we're really at the knees and sort of being beaten about now on our last legs. What needs to happen for us to regain investment grade? I've got a very simple model that, I mean, it's just the most difficult simulations to run. What we need to do is get nominal growth in excess of the interest rates at which we're borrowing. We are borrowing at roughly 12% at the long end. Our government is very keen on issuing at the short end because the 12% is so long. But we need nominal growth in this economy to exceed the interest rate at which we're borrowing. We need spending growth to decelerate to less than economic growth rates, and we cannot afford revenue growth to rise, because any additional revenue growth, so any revenue that goes to Treasury rather than to the private sector, substantially undermines the ability to achieve nominal growth in excess of 10-11%. So that's really my 5 minutes on the economy. Happy to take a couple of questions. Otherwise, Nigel, I think we're back on time.
Thanks, Madeleine. That's great. Yeah, as I said, any questions that you might have, guys, either use the group chat section now, or you can email me and I'll forward them on to members of the team. Rico, over to you to just give us some thoughts around previous crisis and the crisis we're facing right now and the implications. Thanks, Rico.
Thank you, Nigel, and morning to everybody. I've just prepared a couple of thoughts which really come out of 2 articles that we've posted on our website. So many of the participants here may have received it. And these articles really were just to try and help not only ourselves but our clients, navigate this financial crisis. Because I think we're all aware in these difficult times, the hardest thing is to control your emotions. And the reason why we regard that as being quite important is it's because in these times that great opportunities are created, opportunities to buy. But we acknowledge that it's an extremely difficult thing to do, to buy when everyone else is selling. So just a couple of thoughts from the study that we did, and we went back to the sort of late 60s and looked at previous market sort of manias and sell-offs that exceeded roughly 20% from their peaks. And there were 8 of these over the past 50 years. Now, what is interesting is maybe just to sort of observe a couple of the data points, which is that on average, the sell-off from peak to trough lasted about 14 months, and the average decline was around 41%. Now, we're the first to recognize that every one of these crises, the cause of them was quite different, but they all landed up creating the best buying opportunities that you typically tend to see in these 10-year cycles. The shortest one was around 4 months. That was the 98 Russian crisis. That was shortly after I joined the markets. The longest one was well before my time. That was 1975. That lasted 28 months, and that was really on the back of the collapse of the Bretton Woods system. But every time in each of these crises, the markets recovered. And if you'd simply invested after the initial 20% sell-off, on average, you made significant returns in the following 12, 24, and 36 months. Now, the important thing here is you don't have to time the bottom. We're the first to acknowledge that it is an impossibility to time the bottom of the markets. What we do know today is that prices are cheaper than they were a month ago, they're cheaper than they were 2 months ago, and it made sense to buy and allocate some capital. And that's what we did in our portfolios. It's, again, as we highlighted at the outset, it's not something that's easy to do, particularly when the news and the head bad. But the facts speak for themselves. In every one of these previous cycles, you did exceptionally well over the ensuing 36-month period by buying and allocating capital when you get this huge disconnect between share prices and fundamental values. Another key point I think that's probably worthwhile touching on is we've also seen an extremely sharp recovery. And my own personal point of view is that perhaps maybe a little bit too much optimism in the short term. When the SA market fell initially 35%, it's recovered 26%. So from the peak, it's down roughly 18% today. And again, if you look at the market research and you look at all bear market cycles as opposed to just those where the sell-off was 20% or more, and there's probably 15 of them over the last 50 years, we rarely ever saw the recovery happen in a straight line. In fact, in every one of those 15 bear markets, with the exception of one, the markets tested within 3 months those new lows. So we initially, in the domestic equity space, probably reallocated roughly about 10% of the capital within the portfolio to opportunities that we saw arising. But with this recovery, we're happy to sort of sit on the sidelines, and I have no doubt that we will get further opportunities in the coming months to buy high-quality businesses at bargain basement prices. Two last points that I just want to touch on, and one of these we also wrote about in the second report that we put out, and that's probably contrary to what most people would anticipate, is that in this period, investing in gold actually delivers poorer returns than you could get out of other asset classes. So, the time to have positioned yourself defensively is before we saw the sell-off, not during the sell-off. And so we definitely do not advocate, a move into assets like gold at this point in time. And then the last point, and I guess this is the sort of question to which there's probably not a specific answer, but how much further can markets fall? What's currently being priced in? Is the bottom behind us? And the only thing that we could really do and that we've attempted is, again, based on our view that at the end of the day, a business is worth the net present value of its cash flows over the life of that cash flow stream. The impact of 1 or 2 years at the end of the day is fairly small. So what we've done is rather sort of looked at the implied expectation. So if you take the 20% correction that we've seen in the markets from the peak in late Jan, early Feb, and try and understand what the market is sort of baked in terms of two factors. The first is fall in earnings, which is undoubtedly something that we will see over the next 12 and 18 months, as has been highlighted. But secondly, a higher discount rate. So with the downgrade essentially indicates higher risk and a higher cost of borrowing, and that needs to filter through ultimately into our cost of capital. So if you take into account roughly 1% increase in the discount rate and some sensitivities that we've run based on what 1 or 2 months of a lockdown actually means in terms of corporate profits, the 20% fall currently is pricing in a roughly 1% higher discount rate or cost of capital, and roughly around a 15% fall in corporate profits. And again, we're not suggesting that that's necessarily what's likely going to transpire. It could be less and it could be more, but that gives you a peg in the sand in terms of, if we see further market movements, what the market is ultimately implying and baking into expectations going forward. So I think, Nigel, with that, I'll probably leave it there. And again, happy to take questions at the end.
Great, thanks, Rico. While I've got you there, actually, just one question has come from the floor. SARB have just cut repo rate by 100 basis points. Any comment, any thoughts there? I know it's throwing you straight at you. You can handle it at the end if you like.
Yeah, look, I'm sure Madeleta's got some thoughts as well, but at the end of the day, you know, it doesn't necessarily affect the way that we look at the overall cost of capital to companies, but certainly it does provide some reprieve to households who've got mortgages, who've financing vehicles, who've got overdrafts. And then from that point of view, it certainly does cushion the blow a little bit, but perhaps Madeleta's got some more to add to that.
Okay, thanks, Rico. Madelette's just popped off actually to the SARB announcement call, so maybe Koki will have some comments. Rico, thank you. Koki, over to you. I know you're going to have a quick 10 minutes on financial valuations. This is the time to invest, and maybe you can also comment on the repo rate cut. Great, thanks, Koki.
Okay, yeah, if you can come back to me on South Africa at the end. Obviously, I'm firstly just talking on the global financial sector. So I've set my stopwatch as I talked for 9 minutes. So firstly, the market prices reflect fears, not reality. And we're seeing incredible volatility. But I think what's most important to bear in mind is that, you know, the price moves don't necessarily reflect reality at the moment. They reflect a lot of fear out there and a lot of misunderstanding. I think the biggest one is if we go to our base case, in that even the US is talking of ending lockdown end May, beginning June. So we start some form of normalizing. Europe maybe earlier. China's already doing that. And I don't know if you saw Austria, Denmark, Norway already talking about next week. So, but the effect of the bad debts thereafter is what is creating the huge uncertainty in terms of the range of outcomes on financials. And so price moves in that regard are extreme. And I, again, can recommend, look at Rico's 2 articles. And they're actually quite short, but the tables are very instructive in terms of, you know, even if you bought 20% after the start of a fall, you still do well. And in financials, we're already down 45%. Also, Howard Marks's articles, the same message. So you've got to buy when there's panic and when there are a lot of sellers. You know, once it turns, you'll find a lot of buyers and no sellers. So in terms of the financials, the key positive negatives are valuations are very attractive. Sorry, there's a flippant call coming in here that I can't mute there. Valuations are very attractive, and I'm trying to write another article just on that. But if you look at 2008, shares like Capital One, which was a credit card lender, was totally sold down, and from March 2009, it gained 300%. And that's the type of moves you get after you've had sell-offs in financials, and because financials are just very geared to the downside, but also the upside. But I think what is very important to bear in mind regarding 2008 and 2020 is 2020, we've got strong balance sheets, we've got diversified lending. And I think what is very important is that the Fed and the US government have really launched a nuclear arsenal. They've learned from 2008, they've been quick, they've been decisive, and they've been big. So the Fed has actually been saying to the banking system, go out and keep your clients alive. Ensure that when lockdown is over, as many of your clients as possible can stand up and be part of the growth. So in that regard, there's been huge relaxation on capital requirements, on reserve requirements, even on accounting standards, to make sure that nothing stands in the way of the banking sector to play its full role. And as well, the government is using the financial sector to help with the disbursement of loans and incentives. And so on the fund side, insurers are doing very well. I'll quickly use an example of Santam just to illustrate that. The focus is on the bank side. So bear in mind, the banks are still earning interest and fees. And years ago, it was 1980s, I worked in Bankhol for Stoffel Erasmus. Okay, we don't have to go into that history, but Stoffel always used to say, remember, banks are wonderful investments. They actually earn interest even on public holidays. And during this crisis, they're still earning the fees, they're still earning interest. Okay, the whole emphasis now is to make sure that they reschedule those loans and can collect them after it's over. And there will be bad debts, and there will be bank clients that do fall over, but generally it will be, our calculations are between 8 to 10% of the total book. And remember, then they have their collateral in place. So the financial sector now is actually better placed than most other, and a lot of other industries like the airlines, the mines, manufacturing sector, restaurants, tourism, because of its diversification and strong balance sheet. So going into the lockdown, we had the highest quality portfolio ever. In the 21 years I've managed the fund, in this case, in March 2020, we only had, the only turnaround that we had in the fund is ARG. And ARG is already in its 10th year of its turnaround. But again, you can see how panicky the market got. It sold down ARG by 60%. It's now trading at a 0.26 price to NAV. It actually bounced back in April. I don't know if you've seen April so far has been a strong month. But so you can see how the market overreacts. And in some of our other investments as well, the market is replaying the 2008 script, specifically on the mortgage insurers. The mortgage insurance sector has been totally redone. The capital ratios are different. They all reinsure parts of their book. Yet the market believes that mortgages will be as bad as they were in 2008. And you recall in 2008, you had a lot of things happening at the same time, but generally there was a lot of risk and injudiciousness in terms of people were being given mortgages left, right, and center. This hasn't been the case in 2019-20 at all. So, but even in Europe, financials been sold down. Things like ABN AMRO, ING, sold down when the ECB told them not to pay dividends for the next 6 months. Now, a lot of dividend funds, I suppose, had to sell. I'm not sure what caused it, but it caused a 12% sell-off in banks that were already very cheap. So you're now looking to next year when they resume dividends. On the lower prices, you're looking at yields of 12, 13%. It's truly mouth-watering if we get there. Sure, there are going to be bad debts, so maybe they won't pay a full 12% in the first year. But I think in 2021, 2022, we're going to see a lot of bad debts, a lot of dividends and special dividends. So to end off, and then I must get to South Africa quickly. We are now at the position where we've been moving a bit from areas where we had less line of sight to certainty. And if I use a South African example there, in South Africa, that means we would have been selling, let's say, Absa for Santam. I was fortunate enough still to have a call with Lizay recently. And Santam and insurers, auto insurers are having unbelievably good years now, or this 3 months. Because imagine, there's no driving, there are no accidents, there are no claims. So, but the premiums are still coming in. Now, whereas Absa, a bank that grew its loan book fairly aggressively, will most probably have higher bad debts. So we've been switching a bit from in countries and in areas where there was a higher risk to where there's lower risk. But the price moves have been so severe that we're actually really thinking and debating about moving back. So like Santam has held up very well. You should now maybe be switching from Santam into Absa. And so finally, I think what's very important today is we actually start the US reporting season. And so JP Morgan, Wells Fargo, etc., will start reporting. And I think what the CEOs are going to say, are going to be very, very important, because that will give us a good steer in terms of what they are experiencing. Nigel, in terms of the repo rate cut, I think that was expected. Well, I was in this sense that the fear always was that we cut interest rates too sharply, it will lead to a currency depreciation, will lead to inflation. Inflation at the moment is dead, and the currency has already fallen. So I think it's very good what the Reserve Bank has done, and it will simply help a lot of consumers and smaller companies out there. Don't know if there are any questions, or we can in any case take them afterwards. Thanks, Nigel.
All right, thanks, Kogi. That's awesome. And guys, we're almost spot on time there. As I said, I mean, Rico alluded to it. There's Rico's articles on the website. So if you want to have a look, I'd encourage you to have a look. There's some really good quality information there to help with client communication. If you need any further feedback, please email me. We will put together a note with all the key points and issue it out on email probably tomorrow. But thanks to everyone for joining us. I hope very much that's been useful. We will probably do another one of these before the end of lockdown. And it goes without saying from our side, stay safe, stronger together, and thanks again for taking time to join us.